Mike, it's amazing watching all of these alternative products out there to provide some kind of downside protection, these alternative ETFs that are out there. So you mentioned we've had buffer strategies on, synthetic income like JEPI, leverage and inverse ETFs, including leverage and inverse single stock ETFs, options over it. Look, I have a little list here that everybody can read just to try to make sense out of all this. But these products have not been around that long. The buffer's been around for a little while, but there seems to be a real interest in this. Is it because people are getting older? They got spooked by some of the downside we've seen in the last few years. Some people want income. What's sort of driving these? I call them alternative ETFs, but I'm not sure what you would call all of these together. But it's really interesting watching them expand dramatically in the last few years.
Yeah, I mean, I think you can really break it into two halves, right? So you have the younger generation of kind of YOLO, if you will, really leaning into the leverage inverse strategies. The single stock leverage into ETFs have seen $10 billion of inflows year to date, and that's really primarily levered single stock names, and they tend to be the most volatile single stock names. All evidence suggests that that's not institutional money. If you look at 13F holdings, less than 5% of these things are held by institutions. So it's being driven by the retail trade. Now, the counter side of that is the buffer and synthetic income. And I think if you look at the ownership of that, it's primarily driven by institutional ownership, RIAs that are allocating their clients to this. And I think two things can be played there. One is, I think everybody's agreed for a while, we've had historically high valuations. The market kind of needed a reset. And so people were a little bit risk off anyway. But then also, we've had this period of really, how do you allocate into fixed income? So a lot of folks are looking at different ways to allocate some of their fixed income bucket into something that might have similar beta construct or similar up-down captures to that side of the market, but do it in a way where they can still meet that income need and gain some of the return structure of the overall equity market. So a lot of big macro trends on the institutional side, and I think on the leverage inverse side, it's just an idea of more and more people embracing the stock market, more and more Robinhood type traders that are willing to do some crazy stuff.
Well, what I like about these, I've had problems with leverage and inverse single stock ETFs because I think they encourage excessive speculation. But a product like JEPI, this product makes some sense to me. Here's an older investor. I want to stay in the market, but I need to generate a little more income. I'll give up a little upside, which is what you do with JEPI, for the income. This seems to be a product that makes some sense for me. If I'm an older investor, I'm smart enough to know I'm not going to I shouldn't pull out of the market. That's not a good idea. So, but I do need to have some kind of protection. And even some of these buffer ETFs, they act sort of like a collar in a way, make some sense to me. If I'm an older investor and I'm smart enough to know, don't get out of the market, but is there some way I'll pay something to provide some kind of, I'll give up a little upside protection to provide some protection on the downside, you know, sort of collar me a little bit. These products make some sense to me. As an older fellow, I'm almost 70 years old, folks, so believe me, these things make sense when you get up into my age group.
Yeah, lower volatility in the market, consistent income during periods of volatility like now, increased income, and potential upside on the underlying portfolio as well, not completely selling the upside. Yeah. So I think that's important.
And any thoughts on, and I know you're not the ETF Sherpa here, but you are the strategist. What's going to become popular the rest of this year? Bitcoin ETFs were the biggest thing last year. They've kind of quieted down this year. We see other active kind of products coming in to fill a need. Do you have any sense of where demand is going to be for the rest of the year?
So, you know, I talked about earlier that we're pretty much a parity between active and passive ETFs. Obviously, the asset base is much different. And what I'm seeing is that there's a gradual move towards the more traditional asset classes, like large cap growth and large cap value and international. And as the ETF structure just becomes that much more accepted, because there's so many things you can do inside the ETF, in terms of both from a portfolio manager standpoint as well as the individual investor. I see over time, and particularly potentially with ETF share class coming to market potentially this year, a movement towards those more traditional asset class because it's just a better structure.
Yeah, it makes a lot of sense. And as Mike and I have pointed out, Mike writes about this regularly, the overall flows still are passive plain vanilla. The largest flows still are in that passive plain vanilla space still.
Yeah, but the flows this year are approximately 40% of the flows have been active, despite that only 10% of the assets are active.
Smoking like an active manager here, Mike. We keep getting, we're getting the same story all the time. Mike, any quick thoughts here on where we might going on for the rest of the year?
Yeah, I would expect to continue to see a bifurcated market where you have the traditional space is going to keep taking 80-90% of your assets. And I think John lays out a good story for why you're seeing more and more active share in strategic allocations. But if you look at from there, you're going to continue to see kind of the spicy side of the market grow. I think we'll see more and more leverage inverse. Every weekend when I sit down to review all of the new launches, I just shake my head on the leverage inverse single stock side. But then also, I think you'll see more and more innovation on the synthetic income, the buffer ETF strategies that provide kind of an equity light version of the marketplace. So that's I don't see anything big like crypto like we saw last year, but I just think a continuation of some themes that we saw start last year.
All right, that makes a lot of sense. Appreciate that, Mike, as always. And that does it for this week's ETF Edge. My thanks, of course, to John and to Mike. And we've asked Mike to stick around and provide us some additional perspective on ETF trends. He has all sorts of thoughts. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website. This is our 7th year, folks. etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.